countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, you're getting a bit of a lift across the board, up about 0.5% on the S&P, much more on the Russell 2000. Outside of stocks, that is what is allowing stocks to get a little bit of a lift. Yields quiescent. Stasis, not going anywhere that quickly. 4.86% rounded up on the 10-year after a really tumultuous session yesterday. Crude just dipping a touch, and real euro weakness on the heels of weaker than expected PMI data out this morning. Something we're watching today in about 15 minutes is the PMIs over here in the U.S. One stock that we're watching at the open is General Electric, raising its annual profit forecast as rebounding demand for air travel fueled growth in its aerospace business. The CEO saying, quote, "We continue to experience rapid growth driven by robust demand and solid execution. I'm more excited than ever about our path ahead." Sounds like an earnings call. Right now, Bloomberg's Abigail Doolittle joining us with more. Abby.
Indeed, Lisa. GE put up a big beat, but it's not just GE. We're having a day of strength for the industrials overall. Coming into today, the industrial sector about flat on the year. I'm guessing now it's probably higher on the year. Relative to GE, a big beat. They beat earnings by 46%. They beat sales by 6%. And as you mentioned, that strong demand for engines really driving the fact that the company is raising the outlook. CEO Larry Culp, his turnaround plan of multi-year really coming into play here, and he is talking about the aviation operations continuing to experience the rapid growth driven by that robust demand. Now, relative to other industrials, RTX, the former Raytheon, it is having its best days since November of 2020. It is up about 7.4%, also having to do with engines. The loss there was narrower than expected for their engine unit, driving a big beat for the top line, or excuse me, the bottom line. But they also announced a $10 billion buyback, so investors liking that. And 3M rounding out the picture, they also put up a strong quarter as they beat and raised. Some resolution around litigation is seeming to help them. On the year, though, Lisa, it's very interesting because we have 3M bouncing off of an 11-year low. We have RTX surprisingly down 30% on the year after having a big up year last year, but GE up more than 60% on the year. That strength is continuing.
Abby, thanks. From GE to GM, the automaker withdrawing its guidance as a result of the auto strike. I spoke to GM CFO Paul Jacobson earlier today about the decision.
Given that we don't want to speculate where the next plant might be or how long that might be out, we thought the prudent thing to do was to withdraw guidance, despite the fact that the underlying business was actually performing at the top end of our range prior to this. So we'll provide an update with investors as soon as it's over, but we're still focused on making sure that we execute every day.
Katie Greifeld has more. Katie.
Hey, Lisa, yeah, it's unclear what the strikes will mean for GM's full year profit, but the company did say that so far strike costs have reached about $800 million, and going forward, that'll add about $200 million a week in additional costs as this strike continues. Now, that casts a shadow over an otherwise pretty good quarter for GM. The company beat on both profit and revenue. It managed to grow its market share, but Bloomberg Intelligence points out that the fact that they pulled guidance showed that there's still a wide gap here between the companies and UAW in these negotiations. On the bright side, you take a look at the sell side. They don't seem too fussed. Wells Fargo says that the guidance withdrawal, not too surprising given the strike, and RBC actually expects the stock could climb from here given that the strike impact may already be priced in. But in any case, you look at shares right now, currently off by about 1.4%.
Katie, thank you so much. Sticking with earnings, Coca-Cola boosting its full-year outlook despite raising prices and other macro headwinds facing consumers. The CEO saying, quote, "Our leading portfolio of brands positions us to win in the marketplace today, while laying the groundwork for the long term as well." Joining us now, Bloomberg's Simone Foxman. Simone.
Yeah, Lisa, consumers aren't buying a lot more Coca-Cola products, but they are willing, it seems, to pay more for them. That meaning the company able to boost its full-year outlook for 2023 on a revenue growth terms to 10 to 11%. They had seen 8 to 9%. Analysts had expected it to be a little higher than that range, around 9.9%. The company also saying that profits will grow at 7 to 8%, up from 5 to 6%. But the company does see a little little larger foreign exchange headwind than they had anticipated at 6%. We also saw some beats in the third quarter earnings with EPS coming in at 74 cents rather than the 69 cents that were estimated. But the real focus is price mix. As I mentioned earlier, like Procter & Gamble, which we heard from in the last couple of weeks, they appear able to pass on these price increases despite some of these concerns about the health of the consumer. We did see some pressure on volumes. Globally, volume was up about 2%, flat in North America, but contrast this to Pepsi, which is also expecting revenue growth of 10%. It is, of course, Coca-Cola's chief rival, but that company has seen volume decline, especially in North America, seeing a decline of about 6%. The earnings call going on right now, CEO James Quincy saying that the European consumer, in fact, is under slightly more pressure than the U.S. consumer. They are trading down more. We will see if that earnings strength continues, but you're watching shares react in a positive fashion to this news from Coca-Cola this morning, Lisa.
Simone Foxman, thank you so much. And finally, shares of Spotify moving higher after earnings, swinging to a quarterly profit after raising prices within its streaming service and posting better than expected user growth across all regions. The company writing, quote, "We're pleased with our Q3 performance and view the business as well positioned to drive continued progress." All of these commentaries of optimism that we keep hearing from the CEOs. Bloomberg's Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. This is an interesting or odd one because when the numbers dropped, Spotify was trading lower for most of the pre-market session. The market's open. We're currently up almost 7.5%. That puts Spotify on track for its biggest jump since the end of January, and a gain of more than 11% would put it on track to trade at its highest level since July. So this is a pretty big response. Strange, though, given the negative response in pre-market when the numbers hit. Top and bottom line beat. A big part of that is the impact of them raising prices earlier in the year. They had a surprise operating profit which came with it. But you look at the subscribers, right? We're still learning that whether it's an audio video related platform, you kind of live or die by your subscriber count. In the quarter, premium subscribers rose 16% to 226 million, slightly above estimates. But then you go to the fourth quarter forecast and overall active users, both premium subscribers and non-premium, Spotify's forecasting 601 million active users for the fourth quarter, with 235 of those being premium, above expectations. So the impact here of higher prices is working on the bottom line. They're continuing to grow, and also having cut jobs and pulled back some investments and green lights on podcast projects, there is emphasis and evidence that the podcast business is going well, up 8%. And as I said, Spotify on track for its biggest jump since January 31st of this year.
Ed, thank you so much for that. Those are just four of the many earnings movers this morning. We're seeing a whole host of others, including Verizon. And of course, after the bell, Alphabet and Microsoft today, Meta tomorrow, Intel and Amazon on Thursday. More than $15 trillion of market cap are reporting today. Baird's Colin Sebastian writing, quote, "Q3 earnings should generally be in line. We maintain estimates somewhat below consensus for Q4 and 2024, given signs of more fragile consumer spending." Joining us now, Colin Sebastian. Colin, thank you so much. I'm curious just how high the bar is for the likes of Google, like a Microsoft, given how much the shares have run up so far this year.
Yeah, thanks, Lisa, and good morning. So, I mean, we have seen this resurgence of big tech for the year to date that really shows the underlying strength, the structural advantages that platforms like Alphabet have. And quite frankly, what moves the needle for these companies is still fundamentally consumer spending. And with the strong job market, with strong levels of consumer spending, search advertising for Google has been resilient. YouTube has accelerated in growth, and of course a lot of attention on AI and the cloud platform, and we'll get an update on that here in a few hours.
Well, that's exactly where I wanted to go, Colin. How important is it for them to be monetizing the AI technology at this point versus laying the groundwork for just broader adoption?
Well, there are a lot of services for both individuals and businesses that can take advantage of a lot of this transformation, but it takes time. And so, as you say, there's a lot of laying of the groundwork right now, and that comes with cost as well. So we're keeping a pretty close eye on the expense structure. But at the same time, the cloud transition is still happening. Companies are moving workloads And while there's a little bit of cost optimization happening, we still expect well in excess of 20% growth for Google Cloud Platform.
Who do you think is the most underpriced of the big tech names when it comes to AI adoption?
Well, I think Microsoft obviously is benefiting from a tremendous amount of hype related to its partnership with OpenAI. And ChatGPT obviously opened everyone's eyes to the potential of generative AI. So in that context, Google and Amazon probably have received less of the hype, the benefit of that hype. Amazon in particular has traded off over concerns around AWS and growth in the last month or two. So I'd say perhaps expectations are a little bit below where we think they should be for Amazon, but Google as well. They are extremely well positioned in AI. They are the AI company, and we think they'll do very well with this transition.
I have to ask this because everyone this morning has been bringing it up. Do bond yields matter to these companies that don't need to borrow? Is this basically the area that is independent to what we're seeing in borrowing costs just simply because they are cash cows?
Yeah, I mean, that is certainly part of the dynamic. These companies have significant cash balances. They're earning more on that cash, but we can't ignore the ripple effect that higher rates have through the economy. Ultimately, Google, for example, is the world's largest media company. So they can't avoid the cycle. They can't avoid whatever happens to their end market, to businesses and consumers. So we'll be very closely paying attention to what they say today about what they're seeing on the macro front with their customers and if there's any pullback in ad spend or activity with consumers.
Colin Sebastian, thank you so much for being with us. Cboe's Mandy Zhu weighing in on upcoming results, saying, quote, investors are focused on the fundamental drivers for stocks, earnings, and higher rates, while looking past macro risks, such as rising geopolitical tensions in the Middle East. Mandy joining us now. Mandy, you are the person that I want to talk to. Stocks have been almost havens relative to bonds recently. Can that persist?
That's a great question. And I think what's really interesting to point out is that the way that equity investors have been positioning for higher rates and adjusting to the higher for longer rates regime is really through stock selection and sector rotation, not through macro or index plays. And that's why if you look at the run-up in volatility that we have seen over the past few weeks, it's actually really led by single stocks, not the index. So if you look at the correlation of the stocks in the S&P, that's still remarkably low and it's still within the same range that we saw over the summer.
So at this point, as you take a look at earnings, are stocks and implied stock volatility increasing in response to some of the earnings, or really is it just highlighting what a staple it sort of has been as companies look to just general strength and a generally benign backdrop?
Yeah, so I would say if you look at what's been going on for the past 2 weeks, I would attribute most of that to kind of upcoming earnings and pricing in more earnings risk, and actually average single stock volatility is near a year-to-date high, on par with what we saw in March during the SVB crisis. But if you take a step back and look over the past 18 months, what's been even more remarkable is that single stock volatility and the dispersion of stocks that we've seen in the S&P has been really on par with what we saw in 2020. So if you look at the dispersion of stocks in the S&P 500, which you can track by the DSPX index, the average levels over the past 18 months is what we saw in 2020 when the VIX was at 90, right? So that tells you, even though index volatility has declined, we're still continuing to see a lot of rotation, a lot of movement underneath the index surface within these sectors and within the stocks themselves.
What's the main driver, Mandy? Is it really just the macro factors and some of the yield moves, or is this the drivers of the volatility in the specific stocks just directly tied to earnings and the lack of visibility that individual traders have at any given day on what companies are seeing?
To me, I think the primary driver, if you look again at the past 18 months, it has to be higher rates and kind of the incredible sector rotations and swings in leadership we've seen, right, from growth to value, back to growth. You know, we've seen kind of old economy stocks rally last year, and this year it's all about tech, right? Tech down 40 last year, up 40 this year. So that, those incredible swings that you're seeing at the sector and the single stock level, I think that is what is driving the volatility in the market right now is not at the index level. So correlations are actually near historic lows. And historically, what happens is the correlation tend to rise when people start pricing in more recession risk. So that's going to be the big question going forward is, are we at the end of the economic cycle? cycle? Could we really start to see things turn? And until it does, when it does, I do expect, index volatility to start dominate on the back of higher correlation. But until then, the way that investors have been really playing for higher weights is through more through more sector and single stock.
Mandy, I love that we get to speak to you because Tom usually busts my chops when he talks about the VIX, and he says you can be gloomy and doomy, but look at the VIX, it's doing nothing. Has the VIX essentially broken as an indicator of forward-looking volatility?
So I would argue no, and not just because I work for the CBOE. I think a lot of people have been puzzled by the decline in the VIX over the past year. But if you look across asset classes, the decline in equity volatility is on par and in sync with declines that we've seen across currency markets, across commodity markets, across credit markets. So that tells me, again, what's driving volatility lower across every asset class is the macro picture, right? The fact that we've gone from everyone talking about recession to now the consensus view being soft landing. That is the reason why volatility is low, not because of zero-day option, not because of any equity-specific factors. It's really the fundamental picture of the economy has turned more constructive over the past year.
Mandy Zhu, thank you so much for being with us. We really appreciate it. Meanwhile, some fresh U.S. economic data crossing the terminal. Abby Doolittle has more. Abigail.
Well, Lisa, it is coming in better than expected. We're looking at the S&P global PMIs, both for manufacturing services and overall. The preliminary reading for October, and we're looking at 50. That, of course, is the dividing line between contraction and expansion. So we are slightly in expansion territory. The manufacturing PMI came in just at 50, slightly above. Services, 50.9, also above. Overall, 51 above the survey of 50, so a little bit more in line with some of the data that we're coming out of ISM next week. And these, of course, are smaller to medium-sized businesses relative to the ISM that are larger. But again, the economy a little bit more in expansionary territory. It'll be interesting to see whether or not this factors into the Fed decision next week, Lisa.
Abby, thank you so much. Coming up, House Republicans trying to nominate a speaker candidate again.
I think the fact that we don't have a speaker of the House right now is very concerning. I think it's concerning the Republican conference right now.
We'll discuss the state of play in Washington, D.C. That's next. In the meantime, you are seeing dollar strength, euro weakness on the heels of that PMI data. This is Bloomberg.
fact that we don't have a Speaker of the House right now is very concerning. I think it's concerning the Republican conference right now. I really think that over the next 3 to 4 weeks, there are going to be so many shifting dynamics internationally and potentially domestically that is going to force the hand of the Republicans in the House to really get it together and move forward with a Speaker.
House Republicans currently meeting to select a nominee for Speaker from a pool of now 8 contenders. The previous 2 candidates failed to secure enough support to win the job. Tom Emmer of Minnesota emerging as a possible frontrunner. No candidate is viewed as having a firm hold of the party's majority. Multiple rounds of voting expected today behind closed doors before the floor is scheduled to convene at 11 a.m. Eastern and maybe come to some sort of decision. Joining us now, Kaylee Lyons and Anne-Marie Hordern in Washington, D.C. Anne-Marie, I want to start with you. What's the latest? What's the likelihood of us actually having a speaker, not only by the end of today, but the end of this week?
I think that maybe is a big maybe, Lisa, when you're talking about the potential that we could see a floor vote today, and that individual that after this closed door meeting, which will see Republicans voting, it might be a couple of ballots till they decide who the majority is, and that person will be the nominee. But when they go to the floor, can that person actually get 217? Maybe the fourth time's a charm. We went through Kevin McCarthy, we went through Steve Scalise, he didn't even get a floor vote, and then we went through Jim Jordan. Potentially, can Tom Emmer become that person? We also should note Byron Donalds left yesterday. He has some support as well within the conference. He said he's going to be up all night making a lot of calls. And then, of course, there's Kevin Hern, who said, I didn't come here to be second or to lose. So there are other individuals that we could see, even though at this moment it does look like Tom Emmer, who's third in the leadership. He's the majority whip. He has a lot of relationships, close relationships with his colleagues. It does look like he's the front runner, but that question remains. Can he get to 217 on the floor?
Kaylee, where are the Democrats in this, considering there was some discussion about possibly working together for some sort of bipartisan solution?
Yeah, Lisa, when we talk about the effort to get to 217, that's assuming everyone shows up for the floor vote, and you require 217 Republicans to actually get the gavel. There is, though, a possibility that because Emmer is a little bit more tolerable to Democrats, theoretically, at least on the margin, because he did vote to certify the results of the 2020 election, that they could help him out by not showing up for the vote, by sitting it out. That is something that was raised by Democratic Congressman Dean Phillips of Minnesota earlier. He just posted on X this morning that the dysfunction in the House is a national and global security issue, going on to say, I would sit out the Speaker vote if Tom Emmer will fund our government at negotiated levels, bring Ukraine and Israel aid bills to the floor, and commit to rules changes to make Congress work for the people. So that's one possibility. But of course, if Emmer can't even secure the simple majority behind closed doors to get the gavel, if it still looks like the House Republican Conference is deadlocked, then we could see a revival of the conversations of Democrats working with a handful of Republicans to elevate the powers of Speaker Pro Tem Patrick McHenry, at least for an interim period of time, while the House tries to sort this out, Lisa.
Kaylee, Anne-Marie, both of you, thank you so much. We will be covering this, I'm sure, again with you both again soon. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In markets, after that PMI data from the U.S., you could see euro weakness continuing, dollar strength. This is Bloomberg.
day like Bloomberg.
Time now for the Trading Diary. We need to be watching this week. House Republicans meeting this morning as they try again to nominate a speaker candidate. Big tech earnings ramping up with Alphabet and Microsoft after the closing bell. We get Meta results on Wednesday, followed by Amazon on Thursday. And finally, also on Thursday, we get an ECB rate decision and U.S. GDP figures. That ECB rate decision particularly fraught after what we saw earlier this morning with PMIs out of Europe coming in disappointing, the opposite of what the U.S. just reported, with actually PMIs that exceeded expectations. If you take a look at the euro, it is being expressed dipping below 106 at one point. In the equity space, holding on to gains about 0.6%, half an hour into the open. This was Countdown to the Open. This is Bloomberg. About that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, October 24th. Here are the top market stories that we're following for you at this hour. PMI's soft landing hopes. We get instant analysis on U.S. manufacturing and services that come in above 50 with Chris Williamson, chief business economist, and S&P Global Market Intelligence. An industrial rebound. You got big names from GE to 3M boosting their full-year forecast. We see what industrial names you need in your portfolio. And Wall Street pessimism. Jamie Dimon to Ray Dalio add their cautious views at the Future Investment Initiative Summit in Saudi Arabia. We get the latest. From New York, I'm Alex Steele with my co-host Guy Johnson in New York. Welcome to Bloomberg Markets. Guy, it's good data, again, here in the U.S.
It's good data for the U.S., not so good for Europe. So the European data, the PMI data, we'll talk to Chris about this in just a few minutes' time, a real gap beginning to emerge in terms of the economic performance. And it's going to be fascinating to see how the ECB addresses that. But you also address the industrial story. At the top, you look at what's happening with the RTX, what's happening with GE, what's happening with 3M today, all of those stocks doing well, which I think is fascinating. We often talk about kind of what is happening with the industrial economy in the States. Is it beginning to bounce back, and is it sustainable?
Well, I mean, above 50, and those stocks are actually being rewarded for those beats. It definitely feels like a sell bonds, buy stock story that's sort of exacerbated here by that positive data.
Is this just, though, are we just talking about this because tech hasn't arrived yet?
Probably.
Tech's going to be out a little bit later. We're going to get some big names reporting, Microsoft, Alphabet, etc. Are the industrials in a position where they can take over from tech in people's portfolios? Are we going to see people's portfolios broadening out? Is a key question at this point. I think we get the answer. By the end of today, I think we'll know.
Maybe. I mean, or do you just need a more balanced portfolio that doesn't just involve big tech at the end of the day? Or Verizon did really well as a top performer in the S&P. Go figure.
It's amazing. Some of these stocks that are really coming back now. But I think the PMI data, I think, paints a really interesting narrative in terms of the transatlantic divide that is now there. So let's talk about that data, figure out exactly what's happening. Instant analysis with Chris Williams, Williamson, S&P Global Market Intelligence Chief Business Economist. This is his data. Chris, great to see you. The US data is holding up, the European data isn't. Talk to me about how big the divide is across the Atlantic.
It's certainly widening, especially you're referring to the industrial sectors earlier as well. Yeah, that's where we're seeing a big divergence, especially Germany, really in a steep downturn still as you go into the fourth quarter, dragging the Eurozone as a whole down. UK data were also very bad for manufacturing. But in the US, you saw the first rise in new orders for just over a year in October. So it looks like the US manufacturing sector has started to turn the corner already. So much earlier than we'd be seeing in Europe. I think we've still got a long way to go in Europe before you get those numbers into positive territory.
So Chris, does this data, just for the U.S. for a moment, point to a soft landing and any sort of not only stabilization but growth again in manufacturing? Is that sustainable?
It's certainly soft landing, because we've got a marked cooling of price pressures across both goods and services. The rate of price growth we've got now is pretty consistent with the Fed's 2% target. And it's, the price growth is in line with the pre-pandemic average. So it's a normalization of the inflationary environment really that we're seeing in the US now. At the same time, we've managed to avoid so far this contraction of the economy with manufacturing returning to growth. Look, it's still weak though. These are, the PMI survey, the S&P survey has been one of the weakest economic indicators, much weaker than the GDP picture you've got. So while we're picking up some speed, it's still quite lackluster, and growth risks on balance, surely they're tilted to the downside with what we're seeing geopolitically around the world.
So you're not convinced that the bottom is in for US manufacturing? Is that my takeaway from this? Or do you think manufacturing has troughed? The trough may be with us for a while, but the bounce back does come after that.
I think what we're seeing here is signs that manufacturing has troughed. The bigger question is what happens to the larger service economy, because here there's still surely some lagged impact of rate hikes to come. That's a sector that lost a lot of momentum in recent months compared to the nice surge we had in the second quarter, that reopening rebound and the cost of living peaking off. That seems to have really helped growth earlier in the year. We've lost that now. It's a similar sort of thing you saw in the IMF's outlook as well. They were seeing this same picture where that consumer-driven expansion earlier in the year, we can't expect that to continue to drive growth as we go into 2024. So what will drive that expansion?
Yeah, well, exactly.
I'm struggling to find that. Yeah, so I think manufacturing may have turned the corner with that inventory cycle shifting in its favor now, especially in the US. But more broadly, I worry about final demand.
So, Guy, this really pairs up with the ISM manufacturing data that we do get in terms of the trough is in, but it's when the trough is in, you can stay in the trough for quite a long time, which then passes the baton again to services. But in Europe, services were not great.
No, services, the data out of Europe are pretty pessimistic right now.
This is totally an Alex vacation indicator.
Well, it is, but the euro is going to be moving in your favor. What are we now, 106?
Right, and also Taylor Swift is going your way. And I joke, but I'm not. Like, actually, the services actually hold up because of those things.
We'll see. We'll see whether Taylor Swift can have the same effect on the services data in Europe. I think maybe peak Swift may have passed as well.
What? What?
Tough thing to say, I know.
What? There's like no data to back that up. Like zero data.
Well, no, she's going into a market that is in a tough place. Whereas in the US, it was boom time this summer. Whereas I think she's going into Europe now, where the summer boom has passed. So I think just the macroeconomic effect on the Swift maybe a little bit tougher.
The macro to the Swift is different than the macro to the Swift in the US.
Precisely.
Okay, that's not a micro indicator, but a macro.
Timing is everything. I'm sure there's a song in there somewhere. Chris, just talk to me a little bit about kind of what now needs to happen. If you're the ECB and you're the Fed, how do you react differently to the data that you're seeing here? Is this a signal to the ECB that they've done enough? Is the data out of the UK a signal to the Bank of England it has done enough?
So for the ECB and the Fed, the suggestion here is you've done enough. Inflation coming down nicely to target in Q1, so really quite rapidly. It's fading in the service sector, which has obviously been their big area of concern. Those elevated rates of inflation are continuing to come down, and the demand environment is weak. It's not an inflationary demand environment. So that's okay. It's a bit more mixed with the Bank of England. Yes, the overall sort of inflation picture is moderating, but it's still looking stickier. It's still around the sort of 4% mark as you go through into the end of the first quarter of next year, coming down, but not enough.
Yeah.
So it plays to the story that the Bank of England rates are going to stay higher for longer.
Chris, just as we wind up, give me some insight into the services sector, Europe and U.S. What is leading the weakness? I guess it's more a Europe question. What's leading the weakness there?
The weakness is the continued cost of living increase, the inflationary side, as well as this, there was this big surge in spending earlier in the year, and this is payback time from that now. So it's quite simply, we've all spent our money, and now we're tightening our belts.
Are you saying peak
to a
Swift?
bigger extent than the US.
Peak Taylor Swift.
Did you say peak Taylor Swift, like, guys?
There's no money to spend anymore. Money has been spent this summer. It is done. It is over.
Okay,
you can't spend a lot of money.
I'm asking Chris.
Okay.
You're not the peak audience, man. I mean, I don't know. You could be saving for it. Chris, peak Swift or what?
It's certainly looking like it. I'd agree with that.
2 to 1. I'm going to stand firm. I'm saying no peak Taylor Swift, but I like this conversation. All right, Chris, thanks a lot. Chris Williamson, S&P Global Market Intelligence, Chief Business Economist. Although I'm a counter indicator, so...
Precisely, yeah.
Usually if I say something, then it's the opposite that actually happens.
We apply that to everything, whatever you say, that we can basically agree the opposite.
Don't you already do that?
Yeah, but I'm just getting confirmation that this is true. This is
like
fantastic.
it's an official road. All right, well, coming up, we're going to get insight into the question of the day. Can industrials power your portfolio now? We're going to talk to Emily Rowland, JH Investment Management Co-Chief Investment Strategist. This is Bloomberg.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
You know, the first thing I do when I wake up in the morning and to get a barometer on the markets is look at the 10-year.
A lot of this is whipsaw.
We've seen the 10-year move up so rapidly.
Fundamentals, technical elements have driven yields beyond where they probably should be.
There's so many different forces which are buffeting the bond space.
Challenge in the bond market.
We're finally seeing supply come in and really scare those bond vigilantes.
Geopolitical risks like this, you know, they make investors really uneasy.
Yields are higher. They're probably staying here for longer, but you know, the economy continues to do well.
So far as central banks are concerned,
the bond market is helping the Fed slow the economy.
The rising bond yields that we've seen is doing some of their work for them.
These high levels of uncertainty have unfortunately become a new normal.
We're looking for rate stability.
We're in a time of dislocation in bonds.
What you do is you've got to get through it.
Those were some of the Bloomberg TV guests weighing in on the bond market action. It does lead us to the question of the day. You might have a sell-off in the bond market, yields moving higher, but it's earnings that are taking front and center. And can industrials like GE, 3M, RTX, can they power your portfolio? Joining us now, Emily Rowland, JH Investment Management Co-Chief Investment Strategist. Emily, you know, it's fun to talk about industrials as our main question of the day. Do they belong in your portfolio, and how much should they be in your portfolio?
Yeah, Alex, we really like industrials right now, especially in the U.S. mid-cap space. One of the things that we're watching really closely right now is the secular trend of onshoring or reshoring, which is supply chains being moved back to the U.S., this increasing recognition from CEOs here that if you're going to sell something here, you're going to increasingly make it here. We're also seeing this almost industrial revolution that's happening in the United States right now being helped by fiscal spending. Yeah, we could argue whether fiscal spending's appropriate right now, given where we are in the economic cycle, but we're seeing things like the Infrastructure and Jobs Act, the CHIPS Act, the Inflation Reduction Act, or whatever you want to call it. All of those things supporting spending in EV production and semiconductor production. I see it in my travels throughout the United States, especially in the Midwest. So if you can move down in market cap in the industrial space, specifically to mid-caps, and capture that opportunity of where the investment is going, we think that's a great place to think about allocating in portfolios as we head into next year.
Emily, good morning, it's Guy. Let's just talk about, a lot of people have been in tech. A lot of people have owned the Magnificent Seven. We're going to get many of these names over the next few days reporting. If tech stumbles, are industrials somewhere that you should look as an alternative? Should you be thinking about rotating your portfolio out of tech at this point into industrials? Should you be thinking about a broader, more diversified portfolio in your equity book? Can you just kind of talk me through kind of where we are now, where we've been, and kind of where we're going, and whether or not this is an inflection point?
Yeah, we look at industrials and mid-caps as a great way to diversify from that mega-cap tech exposure. As you guys know, we've been overweight technology stocks really primarily as a function of our preference for quality. So we've been looking for sectors and stocks with great balance sheets, tons of cash, good return on equity, low interest burdens. And frankly, the poster child for that has been mega cap tech. But if you look at the returns, of course, on the S&P 500, there's been a lot of ink spilled on this. You know, about 95% of them have been driven by that Magnificent Seven. So while we look at mega cap tech as protecting portfolios from solvency risk, we also have to protect against valuation risk. And one thing I didn't mention about U.S. mid-caps with their significant overweight to industrials is they're actually trading at the most significant discount to their large cap counterparts since the late 1990s. So tech for solvency risk and mid-caps for valuation risk.
That's so interesting. I don't think I've heard the solvency valuation combo in that. Emily, with the industrials mid-cap though,
funding issues could be a problem, and how do you manage that? And also, we've heard from some of the big guys, like Fastenal, for example, like they have the order backlogs because people don't want to kind of leave the queue, but the immediate orders might not really be there. What do you make of that?
Yeah, I mean, I think you've got to screen through industrial companies to find ones that are higher quality. We want to find, again, low debt burdens. We want to look for great balance sheets. We want to look for those companies that are really taking advantage of this, again, industrial revolution that's taking place in the United States. Look for those direct ties to the increase in semiconductor production, the increase in EV production, and really identify those names that have the direct exposure there. And look, I'm not saying that industrials are going to be completely immune from a downturn in economic activity. They're not. But on a relative basis, I think there's a pocket of value there that can be uncovered.
Okay. Emily, at the bottom of the screen right now, I've got news that the UAW is announcing that it's going to widen out the strike. We've seen Stellantis news over the last 24 hours as well. These big automakers have big supply chains, and they are the kind of maybe the mid-cap industrial stocks that you're talking about. How are you thinking about the impact that this strike is going to have? Is it having an impact on the way that you would be thinking about constructing a portfolio?
Yeah, again, it's about screening for quality. So the autos haven't been a great investment over the years. That's an area within industrials that we would be de-emphasizing. I think from an economic standpoint, you've also got to think about how this strike potentially plays out in terms of corporate margins. What we're seeing happen right now, and I think one of the reasons that earnings has been somewhat underwhelming, is that we're starting to see evidence that corporate margins are getting compressed. So we know the cost of capital is going up. We understand how that's impacting consumers. It's also impacting margins.
that we're not going to see any Fed rate cuts until the second half